start the today's market talk. In my view, this is a good time to clean up the portfolio and correct past mistakes. Uh, what is
What
the
is the
biggest
biggest
threat
threat
right
right
now
now
is
is
that
that
there
there
likely to
likely
be
to be
one
one
or
or
two
two
interest
interest
rate
rate
hikes
hikes
in
in
US
US
and
and
India,
India,
but I
but I
think
think
most of
most of
them
them
are
are
priced
priced
in.
in.
So
So
we've
we've
had a
had a
nice
nice
run up
run-up
from
from
April to
April to
July,
July,
led
led
by
by
steep
steep
recovery
recovery
due
due
to
to
expectations
expectations
around
around.
a pause in interest rate hikes and end of the year cutting of interest rate, but that is not happening. But if you see, in India, like all the structural reforms are and now they will start reflecting in the corporate earnings. And hence, at this time, if you are invested in not so
Not so
great
great
quality
quality.
stocks, bought in the last bull market or in this bull market, better to switch to quality names. So basically, what I'm trying to say is that you must move from risky bets to quality bets now, so as to preserve your profits. And almost everything which makes headlines or comes in the news is normally at its peak or has to be very carefully evaluated because all good news is mostly priced in. So, market status, as I see it, markets dislike uncertainty. Minutes of US Fed meeting showed that policymakers are divided over the
For the
need
need
for further
for
interest rate hikes, although they are unanimous in prioritizing the battle against inflation. So, this uncertainty around their decisions is the one which is leading to sell off on the Wall Street. So, what is needed is for inflation to come off is that the economy and the labor market need to cool down. Till the time these two are not cooled down, that is the economy which is looking very strong and labor market which is again very strong, the inflation will keep coming back and there is no uh, interest rate which are brought down. Now the second issue is China, the second largest economy in the world. It is stuttering as internal policy support has failed to spur growth. There was a lot of enthusiasm around China opening up after COVID, but and a lot of fund flows into China took place in early part of the year. But now they are reversing, and one of the beneficiaries has been India because internal policy support has failed to spur growth. So all these interest rate cuts, etc., have not done anything to their growth. There was a deflation in their economy, and they have to boost basically consumer spending, tackle high youth unemployment, and provide support to property sector, which is again having a major problem. Now, coming to India, moderating inflation, sustainable growth, and world class digital infrastructure should help India to a standout performance in a volatile world. There are, as I brought out, there is a continued impetus to structural reforms with ease of business, which should attract more FDI and local investment. Now, I'll take on few stocks.
First stop we will discuss today is Ease My Trip. It saw a strong growth in gross booking, but a compression in margins as commission take rates declined and the cost remains elevated due to competitive intensity. Now, in Ease My Trip, the gross booking revenues improved, grew well, but the realized revenue fell due to pressure of discounts. Cost of advertising and promotion is high, and since company has set aggressive targets for market share gains, profitability will take a hit. The balance sheet has worsened with higher receivables from B2B segment, and the stock is corrected and now it is below all its moving averages, so it's a sell on every rise. Hero Motocorp, customers' preference for personal mobility, focus on electric vehicles, and a slew of launches, especially in the premium segment, are likely to aid demand going forward. Uh, if you see the results for Hero Motocorp, the operating margins improved on lower raw material cost, double-digit demand growth in FY24, focus on premium bikes and electric vehicles, increase in domestic retail market share has taken to around 36%. They recently launched HD440 ex Harley Davidson bikes and subsequently stopped taking bookings after 25,000 applications were received. If you see, the EPS is around 188 expected for FY25. That gives them a price to earning of around 15 times. And with rupees 100 dividend, it's a very good stock to buy on every dip. The next stock is Senco Gold. Is the largest organized jewelry player in Eastern India. It saw Q1 30% year-on-year growth. They have improved their distribution and they are expanding in northern India. At current market price, it is at 15 times P for FY25 and is likely to get re-rated. It is consolidating in this range of around 380 to 400 for some time since listing. So it is a candidate to be accumulated on all dips. Now let's see a few charts. First chart is Nifty 50 daily chart. If you see, uh, this chart has broken from its 20-day moving average where it was taking support last week, and it has now come to 50-day moving average of roughly 19 to 50 odd. And what is happening is it is not able to break the declining trend line, so the trend is now negative, and there is a significant price destruction now. But that 50-day moving average has moved up now. From 250 it has moved to 265 where it is at the present point. So this has to be carefully seen. Now similarly, if we see it in a weekly chart, again indices have been falling for 4 weeks, as we can see here, in four red candles which were there sequentially. But there has not been any major price damage, and it's again having a declining trend line. Though the out here the 20-day average is still slightly far, 18,867. So that is slightly far, but that is a risk where it can fall to these levels on the weekly charts. If we see here on a daily charts, the retracement has been only up to 23.6% retracement levels, but it seems that there would be some more room for decline, so it can fall to around 38.2% retracement, which is roughly 18,785 odd levels. So which is corresponding to the 100-day moving average also on the Nifty daily charts. If we see the Bank Nifty, Nifty Bank is a weaker chart, and as per the retracement level, it is now coming towards 61.8% retracement levels, and so this of the complete rise which took place from March. So this has to be carefully seen from here, and if you see, it is below the 50-day moving average and now heading to roughly 200-day moving average. So the supports would be roughly 43,415 and 42, 495 odd levels. So these are the levels to be looked at. So next week, watch it for 43,000 and 42,500 levels broadly for any support on Nifty Bank. If you see the Nifty Bank weekly charts, again there are four consecutive uh, red candles, declining red candles, and it has come to the support of 20-day moving average. So which is around 43,850. So the here the 50-day moving average is still weaker at 42,000 odd. But there is a divergence here. If you see here, the Nifty PSU Bank index is strong. It has a strong week, and it is above the 20-day moving averages. So it is showing strong trend. But the Nifty Bank Private Bank Index is looking weak, and it is taking the Nifty Bank Index down. So there is a divergence in performance of PSU banks versus private banks. So investors need to be clearly more focused towards PSU banks vis-a-vis private banks, which are looking weak. Nifty 500 index on daily chart. Now this week it has fallen below 20-day moving average, and it is now looking weaker. So the level to see would be roughly the 50-day moving average, which is 16,562 for any kind of support, which is another 200 odd points away. Monthly, if you see, uh, there was a there was a rising trend line, and it broke through the resistance level of 16,000, and till the time it is trading above 16,000 it is in an uptrend. So let's see if it is able to take support above 16,000, then there is not much of change, and this uptrending bull market in broader markets should continue, and this is the index which actually affects the portfolios.
Now the few stocks I will cover technically. First one is Tata Power. Tata Power is having a rising trend line. It is above. It went up. It shot up to around 240 odd or over 2 3 days, and then it has retraced. And now it is coming down. So the level to watch is this level on the, that is either the 50 day moving average or the level on this trend line. If it takes support here, then it should bounce back from there. Otherwise, if it breaks, then it goes into a bear market. So these are the levels to be watched out for Tata Power, because it has whether this was a false breakout or not has to be seen, because it has been declining since then. Next is Grasim. It's a very interesting stock. So if you see, this is monthly chart of Grasim from 2020 April, right? It had a vertical rise, and it became from 400 odd, it went to around 1400 plus. Now after that, it has consolidated for nearly 2 years. Now what it is doing is it is making a symmetrical triangle. So in this symmetrical triangle, so what happens is it has last month it broke out from the symmetrical triangle pattern, from the upper trend line of the symmetrical triangle. So to start a new bullish trend, but so we have to watch what is happening now. Here, what happens with the symmetrical triangle is once it breaks out from the symmetrical triangle, the next on upper side or lower side, the next move is equal to the width of the symmetrical triangle. So if you see here, the width was 1300 to 1800, so that is 500 points. So in case it breaks out, and the breakout, though it is now over the trend line, then it should take it to 2300 from here over a period of time. So this is a stock to be kept on watch. Uh, Grasim is primarily Ultratech cement and few chemical businesses. So we have to look at this. Next is Tata Steel. Now, if you see, there is a declining trend line here on weekly charts, but it had a breakout above that. But now, because of this negative news of China, again this is correcting. So we'll have to see this declining trend line level. If it goes below that, then it becomes weak, which is commensurate to the 220-day moving average on the weekly charts. Other stock which is looking good is Larsen. You see, Larsen had a multi-year breakout, and the relative strength is looking strong now. It is not declining as such. It is still above 70, and it has formed some strong candles, and it is way above the 20 EMA. So, on every decline, this Larsen is a buy for a long term. Next stock is ONGC. You see, ONGC has made a cup and handle here, and it is poised for a breakout over these levels. So if it breaks out from here, then it should take it to 20 30 rupees higher from here. So it had a long consolidation, and now the pattern is clearly visible, and now it is on up move. Only thing which has to be watched is the oil prices, which are someday going up or someday going down. So we'll have to watch it. Along with that, the other point is in the stock is strong because there was no impact of the government action on uh, windfall taxes on this stock. Next, the stock which has broken out on Friday is the Lemon Tree Hotels. If you see, again, this stock has a rising trend line here. So it is looking very strong. It was stuck in this range of 95 to 98 for a very long time, around 3 to 4 months. And on Friday, it has broken out from there. So watch this space, and moment you get it closer to the trend line support, that would be a good level to enter this stock. Now I'll talk about few stocks which I find interesting. First one is Amararaja Batteries. It caters to leading India's automotive OEMs under brand names such as Amaron and PowerZone. Preferred supplier to major telecom service providers, telecom equipment manufacturers, UPS sector, OEM and replacement, Indian Railways, and to power, oil and gas, among other industry segments. It will continue to invest and expand the legacy lead acid battery business. They want to improve their international business to 50% of the total sales as they expand into US, Latin America, Europe, and Africa. They are setting up a lithium ion facility in Mehboob and a energy research and innovation center in Hyderabad at an investment of rupees 9500 crore. Their contribution to the overall cost of the vehicle will grow with lithium ion cells, because that's the electric all electric vehicles, the battery is a major part of the vehicle and major cost. Though margin may not be optimum as compared to present, because these are settled businesses, which is there, but it will be substantial. But these existing lead acid businesses is also not ending very quickly. So, as I brought out, their present international business as part of their revenues is roughly around 13% right now, and their lithium ion facility setup. The first phase is an R&D facility in Hyderabad, a pilot line of 2 gigawatt hour, and a pack manufacturing facility. First phase funding is from internal accruals, as they're not taking any loans, as they are free cash flow positive. The recent fall in the stock was because their promoter company, Clarios ARBL Holding, sold its entire 14% stake at a price of 654. So because of which, in July, I think this block deal took place, and that's why the stock prices fell. Let's see their revenue make. Uh, the sales are improving. The margins have improved. If you see from year on year, the margins have improved, and the profits have also improved over a period of time. EPS is improving. So if this stock had a vertical rise up to 1000 plus, then as the raw material prices started going up and their margins declined. So if you see from their performance uh, at this place, if you see from here, the expenses started going up and the margins started declining, and the stock prices also went down, and the profits also declined. Now they are recovering from there. So now they are recovering from there, and here if you see the 20 and 50-day moving averages cross the 200-day moving average, which is a golden cross, so it becomes positive. Now here they had a fall because the 14% stake sale took place in July. Now the stock is consolidating, so at these levels should be a decent entry point, because it is at good support here at 608 odd. Next one is Garden Reed Shipbuilders and Engineers Limited. Uh, this is primarily catering to shipbuilding requirements of Indian Navy and Indian Coast Guard. The company's net profit rose 53% year on year to 76.7 crore in the quarter ending June. The order book position of the shipyard as of June 30th stood at 24,546 crore. That is roughly, if you will see, is roughly six times their annual revenue. It comprises basically four projects for Indian Navy consisting of 19 warships, three P-17 Alpha advanced frigates, eight anti-submarine shallow watercraft, and four large survey vessels. And what they said in their management commentary was that they expect the shipbuilding industry to get contracts worth 1.2 lakh crore over the next 2 to 4 years. Seeing their financials, it has been improving regularly. So they had a revenue growth of approximately from 580 to 756, that is 30% revenue growth year on year. Net profit is also up, you see, from 50 to 77 crores. That is roughly around 53% growth. And if you see here, net, if you see their revenue is around 700 crore per quarter, so that is 2,800 crore. And if they have an order book which is 6 to 10 times of their revenue, so that means their revenues are going to increase substantially if they are going to execute those orders. So this stock, uh, this stock, it was right, just going in a normal direction. After the management interview, it took off last week, and then it went to 800 plus, right? And so it has basically got re-rated. But if you compare the price to earnings of all the three shipbuilders, they are now roughly at the same level. Cochin Shipyard, Garden Reach, and Mazagon Dock. They're all at 30-32 PE right now. So they are at, and they've all reached the same level because initially the Mazagon Dock ran up, and then now the Garden Reach and Cochin Shipyard have caught up with them. So they are now at the same level, and it is better to buy them at dips only, not at these levels. The stock which I find very interesting is Finolex Cables Limited. It's a leading manufacturer of electrical and telecommunication cables in India. Market share is 22% in organized wires and cables industry. 50% growth in company's optical fiber cable segment has been observed. As more applications start riding on 5G, the need for fiber-based cables will be higher. The expansion plans under which it is setting up optical fiber preform facility, OFC capacity expansion, and e-beam facility are on track. They are considering inorganic growth as a strategy as it expands from a wire and cable company and forays to lighting, electrical, and home appliance solutions. So they are moving into adjacent businesses also. The revenue growth, if you see, is decent. Q1 revenue growth from 1,000 odd crores to 1,200 crore, that is around 19 to 20%. Margins have improved from 11 odd to 12% plus, and net profit growth has been good from 96 to 132, so which is around 34%. The key issue for this company is there is an approval for 1.4 lakh crore plan for last mile broadband connectivity, which should push the fiber consumption in this country. So there, and as they move into better quality products, their margins should improve. So if the margins improve and the revenues improve, then the overall profits will go up. So this is a stock to be kept in mind. Now the stock has got relatively, decent move, but it had a certain move after this announcement came of 1.4 lakh crore broadband connectivity plan. But this stock is now at 20 EMA. So you can look at it at this juncture and look to accumulate this stock, because again this is a long term story, and this is relatively cheaper as compared to its peers, that is KEI and Polycab and other, and they are now moving into those electrical goods space also. So they are trying to generate revenue from these wires and cables to that space also. So I have finished.